European equities are showing a mixed picture this morning, with early trading reflecting a cautious tone. The Euro Stoxx 50 is marginally higher, while the FTSE 100 sees slight declines. This comes as markets digest a blend of corporate earnings and evolving macroeconomic outlooks. We note Morgan Stanley's latest forecast, indicating they do not expect European Central Bank interest rate cuts in 2026. This projection signals a belief in sustained inflationary pressures or a more protracted path to target for the ECB. European Central Bank Chief Christine Lagarde recently emphasized the world's need for clarity on U.S. trade relationships, highlighting potential geopolitical impacts on economic stability. These comments underscore the interconnectedness of global trade policies and European market confidence. Further east, Prime Minister Viktor Orbán has demanded EU action from Ursula von der Leyen regarding Ukrainian oil blackmail. This ongoing situation adds another layer of geopolitical complexity influencing energy markets and diplomatic relations within the bloc. Overall, European markets are demonstrating underlying stability, but with an awareness of external policy shifts. US markets remained closed today, but futures are providing a clear indication of overnight sentiment. The S&P 500 futures, ES=F, are down by 0.29%, currently trading at 6,847.50. Nasdaq futures, NQ=F, show a slightly larger decline of 0.35%, standing at 25,009.50. The Russell 2000 futures, RTY=F, are also in negative territory, down 0.39% at 2,616.00. These modest declines suggest a period of slight profit-taking or recalibration following recent gains, rather than a significant shift in risk perception. Critically, the VIX, the market's fear gauge, is marking a significant drop of 5.56%, now at 22.26. This decline indicates diminished immediate anxiety among investors. The dip in futures, therefore, appears to be a measured response to the latest macro headlines and position adjustments, not driven by widespread concern. Moving to the bond market, we observe a strengthening US dollar, directly correlating with dimming expectations for immediate Federal Reserve rate cuts. This is reflected in the headline, "Dollar strengthens as Fed rate cut chances dim." The implication for Treasury yields is a general upward pressure, as the prospect of higher for longer interest rates makes fixed income assets relatively less attractive in the short term. Investors are recalibrating portfolios, with a focus on how future Fed policy will influence bond valuations. The Bank Policy Institute's statement on Kraken master account also signals continued regulatory scrutiny within the financial sector, which can subtly influence investor appetite for riskier assets and subsequently, the demand for safe haven bonds. Current bond market dynamics reflect a cautious approach, balancing inflation concerns with growth prospects. The landscape of central bank policy is undergoing significant shifts, particularly in the United States. Donald Trump has officially nominated Kevin Warsh as the new Federal Reserve Chairman, replacing Jerome Powell. This appointment marks a notable change in leadership at a critical juncture for the U.S. economy. Warsh, generally perceived as a more hawkish figure than his predecessor, could signal a more stringent approach to monetary policy, emphasizing inflation control over growth support. This perception aligns with recent comments from a top Fed official, who, wary of inflation, called for an extended rate pause. These remarks further cement the view that aggressive rate cuts are off the table for the foreseeable future. For Europe, the European Central Bank's stance remains firm. As noted, Morgan Stanley does not anticipate ECB interest rate cuts in 2026, reinforcing a sustained period of restrictive policy to combat inflation across the Eurozone. Christine Lagarde's call for clarity on U.S. trade relationships underlines how international policy decisions directly impact the ECB's economic outlook and stability mandates. Overall, central banks are poised for extended vigilance, prioritizing inflation containment amidst evolving leadership and global complexities. In commodities, price movements are relatively subdued this morning. Gold futures, GC=F, are slightly down by 0.24%, trading at 5,167.10. However, this marginal dip comes against a backdrop of broader discussion around gold's upward trajectory, indicated by the question, why is gold price rising while silver is falling rapidly? The underlying sentiment suggests gold's continued appeal as a safe haven asset, particularly amidst geopolitical uncertainties and persistent inflation concerns globally. Crude oil futures, CL=F, are also experiencing a minor downturn, falling 0.26% to 77.11. This small movement follows reports of an oil spill near Port Fourchon, releasing thousands of gallons into the Gulf. While impactful locally, the broader market price action remains largely driven by global supply and demand dynamics, rather than isolated incidents. Natural gas futures, NG=F, show a slight decrease of 0.30%, now at 2.98. This aligns with market reports indicating weather demand eases, which typically reduces immediate pressure on natural gas prices. Commodity markets are generally stable, with macro factors dominating short-term price discovery. Turning to individual stock performances, the technology and growth sectors are exhibiting notable movements. Amazon, AMZN, leads with a strong gain of 4.24%, while Tesla, TSLA, is up 3.93%. Meta Platforms, Meta, has also seen positive momentum, rising 2.16%. Nvidia, NVDA, continues its upward trend, marking plus 2.03%. These movements underscore the ongoing investor confidence in growth-oriented tech and the AI narrative. Microsoft, MSFT, shows resilience, up 0.55%, demonstrating stability even against broader market softness. This resilience is notable given recent headlines about drones hitting data centers in the Middle East, highlighting the company's robust operational capacity. MicroStrategy, MSTR, is the standout performer, surging an impressive 9.94%. This significant increase is directly linked to Bitcoin's recent rebound and MicroStrategy's continued aggressive strategy, including a fresh purchase of 3,015 Bitcoin. Michael Saylor's assertion, "We can buy more Bitcoin than they can sell," continues to fuel investor enthusiasm for MSTR as a proxy for Bitcoin exposure. On the other hand, Apple, AAPL, is down a modest 0.35%, while Alphabet, Google, registers a slight gain of 0.31%. The market's current AI narrative strength is a significant driver, with companies like Nvidia, Amazon, and Meta positioned to capitalize on this trend. In the foreign exchange markets, the US dollar is demonstrating significant strength, a trend directly correlated with the prevailing outlook on Federal Reserve policy. The headline, "Dollar strengthens as Fed rate cut chances dim," precisely captures this dynamic. As expectations for earlier rate cuts recede, the attractiveness of dollar-denominated assets increases, drawing capital inflows. This strengthening dollar has broader implications for global trade, potentially making US exports more expensive and impacting companies with significant international revenues. For emerging markets, a stronger dollar can tighten financial conditions and increase the burden of dollar-denominated debt. Overall, the dollar's trajectory remains primarily tied to interest rate differentials and relative economic strength. The cryptocurrency markets are experiencing mixed signals, with Bitcoin, BTC/USD, slightly down by 0.87%, trading at $72,036.49. Despite this minor pullback, the sector remains highly dynamic, largely influenced by institutional activity and broader adoption trends. MicroStrategy, MSTR, as highlighted earlier, saw a substantial surge of 9.94%, directly benefiting from Bitcoin's underlying bullish sentiment and the company's strategic acquisitions. Michael Saylor's continued conviction in Bitcoin is a major factor driving MSTR's performance. His statements reinforce the long-term outlook for digital assets among a subset of institutional players. Regulatory developments continue to shape the industry, with the Bank Policy Institute's statement on Kraken Master Account pointing to ongoing efforts to integrate crypto firms within traditional financial frameworks. Larry Fink, CEO of BlackRock, has also been vocal about his firm's crypto impact, particularly regarding ETFs versus direct trading, underscoring the shift towards more accessible investment vehicles for digital assets. While Bitcoin consolidates, the broader crypto ecosystem is defined by institutional integration and a speculative interest in altcoins, like XRP, as investors consider future valuations. Looking ahead, several key economic data releases will capture market attention and potentially influence policy decisions. In the United States, the upcoming February jobs report is a major upcoming event. Investors will be closely scrutinizing payroll numbers, unemployment rates, and wage growth figures for insights into the labor market's health and its implications for Federal Reserve policy. A robust jobs report could further diminish rate cut expectations, supporting the dollar and potentially dampening equity enthusiasm. In China, the government has set its economic growth target below 5% for the first time at a key meeting. This signals a strategic shift towards quality over quantity in growth, with significant implications for global demand and supply chains. Meanwhile, the UK CPI inflation forecast for 2026 continues to be a point of discussion for European markets, highlighting persistent inflationary pressures. These scheduled releases and policy announcements hold market-moving potential, demanding close monitoring from investors. Today's market session is characterized by a cautious tone in Europe, while US futures show modest overnight pullbacks. The appointment of Kevin Warsh as the new Federal Reserve Chairman marks a pivotal policy shift, with potential implications for future rate paths. Central banks globally are signaling extended vigilance on inflation, leading to a strengthening US dollar. The tech sector continues to demonstrate resilience, particularly in areas tied to the AI narrative strength, with MicroStrategy surging on Bitcoin's performance. Key upcoming data, especially the US jobs report, will be critical for shaping near-term market expectations and central bank rhetoric. Investors should remain focused on data dependency and evolving monetary policy guidance. That's all for today's market update. If you found this analysis helpful, please leave a like and follow for daily market insights. See you tomorrow.